Hi, it's Brooks and Chris from Marv and MG Real Estate Advisors here to bring you the June 2024 Housing Market Report. So, what's going on? Are we in a housing market bubble? Are rates going to drop? Is the inventory as bad as last year? Let's talk about it. First, let's summarize what we are currently seeing in our current market. Active inventory. The current active inventory has increased 166 homes and is now at 2,786 homes, which is its highest level since December of 2022. So no, inventory is not as low as last year. It's actually up 16% or 776 homes. Now demand. Demand has dropped by 1% with 1,640 current pending sales. Demand will continue to look similar to last year until mortgage rates drop below 7% with some duration. Until then, housing has transitioned to the summer market when the inventory slowly rises and peaks and demand slowly falls. Back in April, 36% of homes closed below list price and 50% of homes closed above list price. Now this could be for a number of reasons, such as overpriced or underpriced listings, the condition of the home, and so on. But with over 50% of homes going for over list price, that still shows we're in a seller's market for most of Orange County cities, and with inventory still being lower compared to pre-COVID years, this trend should continue until we reach a more balanced market. Now, for the expected market time. With supply rising and demand falling, the expected market time, the number of days it takes to sell all Orange County listings at the current buying pace, increased from 48 to 51 days in the past couple of weeks, its highest level since January. Now last year, it was 41 days, which is definitely faster today. Now for the luxury market. The luxury market consists of homes priced above $2 million. The active inventory in this market is currently up 47 homes and is now at 1,018 homes. Luxury demand has decreased by 12 pending sales and now sits at 249 pending sales. And for the luxury expected market time, it is now at 123 days, its highest level since January. Now something interesting I want to touch on is many believe that decreasing mortgage rates will cause home prices to drop, but this is not the case. Instead, lower rates boost buyers' purchasing power, leading to higher demand. Let's say a buyer is looking at a $1 million home at a 7% interest rate. That monthly payment would be $6,653. Now, if rates drop to just 6% and to keep the same monthly payment, that buyer can now look at homes that are $1.11 million. So as you can see, with lower rates comes increased purchasing power, which would only lead to increased buyer demand, which generally drives up home prices. Now, I'm going to pass it to Christopher, and he's going to dive into inflation and mortgage rates.
Thanks, Brooks. Let's jump right into the economic data and what has impacted mortgage rates thus far this month, and the Federal Reserve's position after their June 11th and 12th meetings. Now, we provide this information to help buyers and sellers better understand the movement of mortgage rates as they impact inventory and demand, which are key elements to determine if a market is in balance, as Brooks has touched on earlier. As you can see by this rate chart, for the first 2 weeks of June, rates continued their downward trend until June 7th, when non-farm payroll data for May came in at 272,000, much higher than the market forecast of 182,000. That said, when the Fed is battling to reduce inflation, this increase is viewed as bearish, meaning the Fed isn't likely to reduce the Fed funds rate, which influences interest rates and in turn affects lending rates. Keep in mind, this is just one piece of the economic inflation data. On June 12th, you'll see in this screenshot, both core CPI and headline CPI data came in below forecast, as well as below the previous month, which immediately impacted bonds. As you can see in this chart, mortgage rates quickly trended downward. In the last 2 years, the lowest headline inflation data reported was 3% in June of 2023. Now, we had to go back a little further to April of 2021 to find lower core inflation data of 3%. Let's just hope this trend continues. The balancing act continues for the Feds, despite the latest encouraging inflation data. The Fed has been clear that their decision to reduce rates is data dependent. So they want a more sustained downshift in inflation to build the confidence needed to offset any risk to the economy before cutting the Fed funds rate. As of Friday, June 14th, these were the nationally surveyed rates based on a 75% loan to value ratio and a 780 FICO score. This chart also provides some good perspective on rates over the last year. And there it is, your detailed update on Orange County's real estate market trends for June 2024. Monitoring these statistics and changes is essential for making well-informed decisions in this dynamic market environment. The latest data reveals a market experiencing shifts, offering both opportunities and challenges for buyers and sellers. If you find this video useful, please remember to like, share, and subscribe for more updates. Until our next update, feel free to reach out to us with any questions you may have. Thanks for watching, and we'll see you on the next video.